Good morning. Thank you for participating to our update webinar today for Invest Numen Credit Fund. I'm here with the founder of Numen Capital and portfolio manager for the fund, Filippo Lanza. So today we want to give you a little bit of an update for the macro overview, where we see a lot of opportunities, but also to go deeper into the idiosyncratic opportunities, which are many for the fund in this moment. Filippo, I leave you to our slides. I would say we can take like half an hour to go through our slides. Anytime, if you have a question, please use the chat, and I will revert them to Filippo.
Yeah, absolutely. Thanks, Laura, for introducing me, and thanks everybody for being here. We just want to give you a quick update on what we think is relevant for our investment landscape at the moment, and what we think are the opportunities and risk going forward. We dedicated the first slide to what we think is the real driver for financial assets pricing going forward, which is the deficit expansion that we are witnessing globally, from the United States to Italy, UK, and the rest of the world. We think that's very relevant because that's the one thing which will be a very lasting effect of COVID, and what we're seeing, the incredible reaction first of the monetary authority, and then secondly by the fiscal authorities. In a nutshell, we basically think that demand and supply will be the driver. Demand and supply of government bonds and refinancing cycles will be the real driver. We're not really concerned particularly about the level of inflation or inflation expectation, or the ability of central banks to raise interest rates. We don't think that that's the main driver. They're probably going to be farther down the road, but what we will see week in, week out will be these attempts to match demand and supply on government bond issuance, and we are very concerned about that. If we move to the next slide, obviously the main focus is the United States. They already approved a new package under the Biden administration of close to $2 trillion. They are in the process of working on an infrastructure bill. We think that will probably produce anywhere between 2 to 4 trillion of expenditure. The market is not fully appreciating the nature of Biden and Kamala Harris, as opposed to very, politically intense leaders we've seen in the past, whether it was Trump, whether it was Obama before, even George W. Bush with the Middle East wars. Those are not really politically very well-defined characters. Those are part of the parliamentary mechanism, and that's where they devoted their career for the last few decades. So if you put together Kamala Harris, who's like a lawyer by training, and Joe Biden, they pretty much spend their entire political careers effectively running spreadsheets, trying to buy and sell votes to pass legislation. Whether it was Obamacare, whether it was the fiscal package in 2009, it doesn't really matter. They're really good at that, and they will deliver on that, as we already seen. Let's not misunderstand the balance of power in the Senate in US. The only real restriction is filibustering, which is not even a parliamentary regulation. It's not even codified. It's definitely not a law. It's more like a practice, which has been violated a few times, both by Republicans and Democrats in the past. So we are really confident there will be a decent amount of spending. Our historical analysis of spending across any jurisdiction is that two things are very relevant. The first one, most spending is very much a collective effort. There is a lot of opposition verbally, but in the end, when it comes down to voting at the committee level, most people agree, whether it's Italy or America or France, UK, which means expenditure will be good. Politicians are very good at spending. The second observation that has to be made is that when you spend, it's very difficult to come back from that level. And we've seen it with Italy, which I think is a very good template for what we will see going forward, We had a very politically divided country after the Second World War, and the glue for that political union was effectively spending money, which basically increased the debt. And most of that expenditure was a state intervention in the economy, whether it's banks, companies, and so on. We will see more of that. We don't even dismiss this concept that China is becoming a sort of a new template with their, political intervention, whether it's on the fintech sector, whether it's in the economy. There will be more of that coming. So our main point is that at the end of the day, the Federal Reserve, all they need to do is to stay put, to effectively, gradually, marginally removing their market put. And the reason why we're saying that is that the QE that we are witnessing right now is way smaller than the supply of bonds which is coming up. And in relative terms, that imbalance is way worse than what we've seen in 2009. So in other words, the QE that we've seen after 2009 has been a lot more aggressive than what we are experiencing right now. And that's very important because demand and supply is at the end of the day what really determine the level of pricing. We're now focusing on Turkey. Why Turkey? Because the market is going to be very, very discriminating. There is probably only one big country that can do whatever they want, whether it's yield control, QE, cancellation of that, and that's Japan, because they are net creditor globally, relatively, strong economy to a certain extent. They've got Bank of Japan has already owned a big chunk of the debt. There is very little inflation. So that is the only country where we see an alignment of the infrastructure, the economy, the balance of payment, the macro variables, and the political commitment. If you then move to the United States, it's probably the second most powerful. Then obviously there is an issue with the fact that the United States is a net debtor. China and Asia are probably the biggest, largest holders of that. And then if you move back from there, the situation gets a little bit grayer, a little bit uncertain as we move. Whether it's Europe, is there really a political commitment there? Is Italy at 160% debt GDP? Is it really sustainable? Is the ECB going to keep on buying? Then UK, where probably the currency is going to be, one is either the currency or the rates eventually for Bank of England. And then so on until countries like Turkey, where we are structurally bearish. We're structurally bearish emerging market. We've seen the desperate search for yield will be badly damaged in the next few months, few years, because Turkey, like everybody else, they'll have to compete with a lot more demand for funding. Turkey will have to compete with Greece, with Italy, with UK, with United States, and it will be a very fierce competition. So our main point there is that let's not underestimate the demand and supply. We need to stop thinking with the forma mentis we study at university on macroeconomic models that have no meaning or bearing. What matters is what happened historically, and what happened historically is that spending, when it gets started, is very difficult to be reversed. Most of the time is inefficient. And what we see now is a big decoupling between the monetary policy and the fiscal policy. And eventually there's going to be a clash of that. The difference that we see going forward is that demand and supply of bonds will be the real driver. So the macro opportunities we see are incredible. We think, a long only, especially if levered portfolio fixed income is destined to produce like material losses going forward. Especially if it's not diversified with good pockets like stress, distress, relative value, or other, absolute return strategy. And we think, again, we need to stop thinking about inflation or central banks increasing rates. Central banks spend 250 billion a month. The moment they reduce that even by 50 billion, it would have a massive monetary base destruction, which would affect the valuation of assets, which have been going exponentially. On the reverse of that function, the chart could become very much, concave or convex, depending on the condition, and it could be very brutal. So like we said to our investor, and we said to ourselves every time we look at the portfolio, the worst thing that can happen to financial markets right now, not to the real economy, but to financial markets, is that COVID is not an issue anymore. And we're very confident on that. We were confident in March when we said the humanity would have overcome this. We produced in less than 12 months, we produced almost 10 effective vaccines when the market was expecting probably on average 2 years to produce one. with an efficacy rate which is way above any of the other vaccinations that we produced in the past. And that is nothing compared to what we could have in terms of medical protocols. Tomorrow there could be a drug being announced that effectively is going to remove all the COVID effects within 24 hours, 48 hours without having to need a vaccine. That would be very disruptive for the market. We think the Fed will be very happy to see the fiscal authority intervening, and most importantly, intervening what is the biggest challenge for economies going forward, which is this massive imbalance and inequality between the people that have and people that don't. Inequality that they know they've been boosting over the years. So the worst thing, as I said, that could happen to the market, and that's the biggest risk we see for valuation, especially in fixed income, but also true for equity, is that COVID is not a problem anymore. We're quite confident. We think, the vaccination rollout in US is impressive. UK has been amazing. Israel is probably the future where we are going to go to a certain extent in terms of statistics. Europe obviously has been a disaster, but over time we think we'll get there. The weather would help, so we'll get into this a bit of a roaring 20 picture during the summer, and that could have a disproportionate effect on valuation. How we deal with that? Well, two things. On the top down, like I said, on the macro side, as we proved last year, we will be very opportunistic. We think we already passed the turning point. We had a big exogenous shock, which was COVID, with a massive monetary policy reaction in line with what we've seen since 2009. But then following that, we had a massive fiscal policy reaction that probably is way more than expected, whether it's from Italy, UK, US, and that will have very, very lasting effect. So macro, we stay very opportunistic. On the bottom up, on the idiosyncratic, we truly are absolute return. So we engage in a variety of strategy, which include the long and the short, relative value, capital structure, M&A, and that is this slide that is out there is a testament of what we're doing. We trade across the full capital structure, whether it's within a single name, within sectors. That will give us the flexibility to have a diversified portfolio and take advantage of this opportunity, because by and large, the markets will be very difficult to be making money on the long only basis, especially when it comes down to fixed income, especially when it comes down to investment grade. So if we move to the next slide, obviously one big item for us will be stress and distress opportunity. We think there will be plenty of stress and distress in macro. Obviously, the history of debt is quite clear. Debt very, very rarely gets repaid. It gets rollover, it gets inflated, it gets restructured, but very rarely gets repaid. It's true for the macro, it's true for history, it's true for companies. What we've seen with COVID, obviously on the macro side, we said, big expansion of deficit, big expansion of public debt, shocking numbers never reached before, but it's also true for companies. There's a lot of companies that have been, impacted. They lost revenue. They had to increase debt. And on top of that, which is a big issue with interest rate, is what we call the tech winter. We had this turbo acceleration of investment in technology, which basically creating overcapacity, and that will play out over time. Credit obviously is the, if you want, the old part of the economy. Companies that issue debt is because they've been around for a long time. And so you already have an adverse selection in that universe, which is companies that probably been having trouble and they've been issuing. And so that's where we see an enormous amount of opportunity on stress and distress. Stress and distress is where you're going to have the ability to make, 50, 100%, probably more on cash, but obviously you need to have a diversified portfolio, because for every 10 names that you have invested, there may be 1 or 3 that are actually going to go down to 0. And that could be the case for stress and distress. We've been involved there for a long time. It's something that we've done. It's something that I think the market doesn't have many skills available on, or much capital deployed, but that's where I think the opportunity will be. And as always, for stress and distress, is the best way to approach it for us is to engage into the full circle of life, so to speak, i.e. to have the short when the name is investment grade but doesn't make sense, whether it's Parmalat or whether it's Parmalat or Wirecard or Greece, and then when the bonds get effectively overpriced on the way down, and the methodology of the market start thinking about liquidation when actually it's going to be a restructuring, that's when you actually buy the security and you're going to have equity-like return. Wirecard has been a perfect example. Been involved for like 2 years. We always smelled it was a massive fraud, but the market always went against us. But we had a relative value capital structure trade. We had long convertible, very heavy short on the equity put, and when in the matter of a week we had the equity going from close to 100 to 0, and the bonds moving from 80 to 5. And so we made money on the short, but when the bonds went to 5, was way below what we thought was the liquidation value and litigation value. So then we bought the bonds and we sold them at 15 within 3 or 4 days. So those are the kind of opportunity we're going to see in stress and distress. They're incredible, but you have to be diversified and you have to do a lot of fundamental research. We'll give you some examples, some idiosyncratic plays. Obviously, investors look at us as a macro shop. We do a lot of macro credit, and our kindergarten has been very much upgraded. We have a lot more debt to play with, but at the same time, there's a lot of plays that we do which are very much bottom-up idiosyncratic. WeWork is actually quite topical. We didn't have the slide last minute, but it seems they're actually managing to go through a SPAC, so to if you want recover from the disastrously attempt IPO they did a few years ago. We very much like WeWork after COVID. We think COVID actually made their business model kind of sensible to a certain extent. And we like the bonds when they were trading in the 30 and the 40s. They are getting close to par now with a SPAC. Great story. Again, need a lot of fundamental research. WeWork is a very, very difficult company, but behind that they got SoftBank, which has been pretty much liquidating investments and an increasing valuation. And that's a perfect example where the equity valuation actually transfer value to the credit side. We can move to the next one. This is AMC. Obviously, everybody has been obsessed with what we saw with GameStop, AMC, American Airlines, Nokia during the kind of the meme stock trend. First of all, it's very important, the meme stock, because I think I find very moral a lot of the commentary where they blast these poor retail investors when actually they're quite smart. And they're doing nothing else than what professional hedge funds managers have done for the last 30, 40 years, with the same kind of level of morality or legality around it. What we found very interesting in this kind of situation, we've been involved with both GameStop, AMC, American Airlines, is to people like us, absolute return, they offer great opportunity. AMC is the perfect example. The equity valuation is pretty much insane. And according to any traditional yardstick or metrics, but that allow a smart management to actually start converting debt into equity or raising equity outright. So we had conversion of convertible into equity, we had issuance of equity outright. So that creates an enormous opportunity to buy credit, which is still trading as a stress distress, and the equity and shorting the equity, which is trading at a value which doesn't really make sense, because eventually that bridge will be closed. So it's like sort of arbitrage, fundamental arbitrage, but where actually there is a trigger to close it. GameStop is something that actually, when we look at it, we thought actually was a long, because again, similarly to WeWork, we had shareholders coming in with an incredible pedigree. Whether by luck or by construction, they did get a lot of things right. So GameStop is something that we found really, really incredible from that point of view. Now that we're talking about meme stock, one thing which we want to remind people is that the other big lesson we learned from meme stock, obviously, is the structure of the market. The market can move very, very fast. The retail participation is all-time high, and we don't think it's going to change massively. We think the market, the way we know it, has removed a lot of transmission channels, a lot of oiling mechanism of that pricing infrastructure that we've seen. Hedge funds being very much impaired. They're much smaller. They're a lot more long only than relative value. On the other side, obviously, we have a lot of investment banks that reduce their capital commitment, their proprietary desk, their market making. We have massive retail participation, then we have a lot of vehicles which are like, whether they're UCITS or ETF, which are going instantaneous liquidity. As we've seen in January and February with those stocks, the movement can be pretty impressive. And that's, I think, is something that we need to keep in mind, but for us, it creates great opportunity. So if we move to the next one, as an example, is TUI Travel. As I said, we're very, very positive on on COVID being removed as a threat. We think probably by the end of the year we'll have a combination of protocols and vaccines that, will make, at least in Europe and US, will make COVID a thing of the past. But we think the reopening will be very slow, much lower than expected, and price. TUI, again, it's a great story where there's a lot of transfer from credit to equity and vice versa. We think equity is very overvalued, it's been overvalued, so we're short via put option. And then we think credit actually is a lot more valuable in this kind of context, and eventually, again, that gap will be closed with different capital transactions. If we move to the next one, again, M&A, it's going to be a big strategy for us. We said it many times to the investors that have been with us for long, that M&A is the perfect place to find the companies that are going to struggle, the next distress. We've seen it with names like Bayer Monsanto, we've seen it with Wirecard making several acquisitions. We've seen it historically, companies that actually make a lot of acquisition eventually end up pretty badly sooner or later. But it's also a sign of the sector having trouble. So we've seen it in this case. For example, we've been involved with Slack, with Market, with many others, Grand Vision, T-Mobile, Sprint. There's going to be plenty more M&A. Some M&A will be what we call negative M&A, like we've seen it recently with Intel, where basically the regulatory pressure and government pressure eventually will be such that not only you're not going to be able to buy other companies, but you're actually going to be forced to or incentivized to invest a lot more in internalized process that before was part of the overall supply chain, which obviously cast a bit of a shadow on the inflation expectation. If we move to the next one, again, another idiosyncratic opportunity, which for us has been really good and is still very, very attractive, is the cannabis sector. We're not particularly positive on the cannabis sector. There's a lot of excitement with legalization and so on. The sector has got a big disconnect between equity and credit, and that again offers us the opportunity to be long credit and short equity at a very different implied valuation. We've been involved with the convertible. We think the credit is very cheap for cannabis, as opposed to equity, which is very expensive. And then even within that, obviously, there's a lot of disalignment in valuation and relative value. But then again, those have been part of the mammoth stocks, and obviously, they were a fantastic entry point for us. The energy is a big sector for us. There's a big transition coming through. We've been involved on the distress on the traditional, the oil and gas, so Peabody and Occidental and British Petroleum also to a certain extent. So there's plenty of opportunity there, especially mispricing. We also been very involved in the new future, which is the alternative energy, fuel cell plug, and we're very we're truly relative value. So for example, fuel cell was a long beginning of the year, it became a short briefly during February. We think there's going to be plenty of volatility in that. What we find very interesting about the alternative energy sector, which is a proxy for the rest of the market, is that one thing has happened in the last 10 years with rates at zero that propelled a super investment cycle in new technology. Those new technology are highly disruptive. Money is highly compounding on that because technology improves every day. So whatever the business plan was from an alternative energy guy, 5 years ago, that would have required 10 years and 1 billion. All of a sudden, the market priced that business plan instantaneously because there's no interest rate. So the future is the present, the dream is reality. And then that company can raise money. And if the company can raise, instead of $1 billion, raise 2 billion, then the business plan is not 10 years, but it's 2. So similarly to what we've seen with the vaccination and with the vaccines, and we will see with the medical protocol on COVID, but we will probably see it also with alternative energy. And I'll just fixate to the price of hydrogen. The price of hydrogen will be highly, highly deflationary. Does that mean that we're going to see those revolutions coming through much faster? Probably. Is Tesla such a great investment on electric cars if we move into hydrogen much faster because there's a lot more investment? Question mark. There's going to be a lot of these big drivers out of energy. Is a sector we're super focused on, and we think there will be plenty of opportunity, whether it is stress, distress, credit, long, short. ESG will be a big driver. with very, very negative oil and gas, because we think the carbon emission pricing, the ESG, they will be one of the big drivers of inflation going forward. We can't forget about job salary-driven inflation in the new economy, but we will see a lot of regulatory-induced inflation, and ESG carbon-driven, it'll be a big driver. So if we then move back, well, EDF is another great example in the energy sector. Is one of those kind of Dr. Jekyll, Mr. Hyde kind of stock. There is a lot of nuclear, which is exactly what no ESG guy wants to see in their portfolio. But at the same time, obviously, there's a lot of alternative energy, and that is a great story. That is a mixture of event, M&A, and if you want a bit of macro in terms of negotiation between the French government and the European Commission. But that's, you know, a great story that we've been involved always in the energy sector, just to show you how diversified we are in the energy, and again, all across capital structure. The other things that we want to, you know, point your attention, obviously, typically we very much around big leverage, credit, and so on. One of the things that we develop now, given the speed of technological change, is always to try to have a bit of portfolio of a very small position, highly diversified, and what we think could be really, really disruptive technology. We had last year on some of the alternative energy. This year we have a bunch of names. One of the names we really like is this Myomo, where basically they produce wearable medical robotics. And we think like that, there are a few of those companies, and for us, those really become call option on specific trends that we truly believe in that could be highly disruptive. Like I said, obviously we have this big macro top down where we incredibly opportunistic. We think we're already past the turning point. You know, demand supply will drive it, and I think it's negative. It's a big negative trend, so we are short rates. On the other side, we have this bunch of idiosyncratic stories where there is, you know, EDF, WeWork, Ferroglobe, whatever it is, they're really following their own kind of, you know, universe and narrative. In between, there are a lot of big trends that we're true believer. Obviously, there's plenty in the economy. There are certain that we're really focusing on. One we spoke about, which is the alternative energy and the transition, which overall we think will be much, much faster than expected. Electricity, electric cars could become a thing of the past way too early in our view. The other big trend, big sector we're focusing on is 5G. We spoke about it at length since March. It'll become more and more and more strategic. You know, there'll be more and more investment from governments. You know, 5G is one of the places where you have to be, as a government, you have to protect that place. There will be one of the field of major confrontation between China and the rest of the world. And it'll be one big discriminating factor in most of the alliances moving around across the world, whether it's NATO, whether it's NAFTA or so on. We have involved there in a variety of ways, whether it's T-Mobile, whether it's Dish, again, plenty of opportunity across the capital structure. One other big thing which are involved is Fintech. Fintech, we see an enormous amount of losers, which are the traditional financial industry, especially banks. We're really negative on banks overall. We think they have pretty much everything against them. They got Fintech coming after them with super investment cycle in that, with a lot of the pipeline, which is not visible, but is happening. We see an enormous amount of portfolios of banks focused and concentrated on commercial real estate, which will have to be repriced sooner or later. And I think that will be repriced down significantly. And that dwarfs any size of subprime issues we had in 2008, 2009. Those portfolios are still completely mismarked in our view, and that will come down. On that, we have traditional non-performing loans, which will be going up no matter what subsidies are coming from governments. And so banks is definitely a place where we're negative. We're quite excited on a lot of startups on Fintech. Obviously, there's a lot of excitement now, so tactically, it's not something we are long. We're short on the equity side. If anything, we've been playing on the long side, names like Unicredit or like Cardlytics in US. But at the same time, it's something that long term we're very, very cautious that could create as well, again, tension and pressure on the financial system. So those are the trends in between, if you want, the kind of top down and bottom up that again allow us to be highly diversified in the portfolio.
Yeah, maybe it makes sense just to have a comment on the performance contribution in the last 14 months. We are missing February here, but you can comment on it. So all the parts of the portfolio really contributed so to this great performance.
Yeah, I mean, like I said, for us, we are multi-strategy, focused predominantly on areas where there is an enormous amount of debt or leverage, and obviously that investable universe for us has expanded, and the pricing has made it much better in terms of risk reward. So what we are particularly pleased, apart from the absolute return for the funds last year and this year, is actually the ability to produce those returns with a very good risk-adjusted combination and a very high level of diversification, which we think is here to stay. Like I said, I think the macro trends are pretty clear. The valuations are mathematically skewed in our favor. The volatility, economic volatility, idiosyncratic volatility will create plenty of bottom-up situations. So overall, we feel quite confident that this is a perfect market for us. I also feel very confident that absolute return strategy worked fantastically well for the last 10 years. I think they're going to be really, really challenged going forward. And as I said, I stand by our main focus now, which is the worst thing for financial markets now is going to be what is best for the real economy. And we're very confident that we will get into some sort of roaring 20s sooner or later. We will get past COVID sooner or later. There will be issues, there will be bumps around the road, but we'll get there. But that would really be a massive headwind for fixed income in general. And I think there's a big trend that we see, which is this passage of power from monetary to fiscal. And we cannot underestimate how big and how irreversible that will be over the next few years.
Okay, I think we can open up for questions. And okay, in the meanwhile, maybe you can, I think it's important anyway, we described a lot of opportunities, but what do you think could be a real risk for the portfolio today, apart from, I mean, what comes if, of course, COVID is resolved, but we think that for us is more than an opportunity than a risk. So what could be a real challenge for the portfolio?
I think, the COVID, to be honest, I mean, is what every portfolio should dream, because they would keep the rates down, and that would facilitate more intervention from central banks, which personally, I think we are the other way around, as in COVID will be, removed as a risk. I think the biggest risk, I mean, there's always plenty of risk for our industry. First of all, to be consistent with what I just said, eventually there'll be algos and robots doing our job better than us. Hopefully they're a few years down the road, but this coming. And I think, on that, we're trying to be, to take advantage of that within our limited budget, but we're trying to take advantage of a lot of the new technology to capture sentiment from social media, to facilitate the AI support for fundamental research. So, but that's definitely one risk that will become dominant going forward for the industry. For the portfolio, I think the biggest risk for me is what we've been talking about when we approach the meme stocks. And meme stock, I think, is the wrong name. It's not just that these are the meme stocks; it's that this is the market. There is this completely misplaced perception of real liquidity for a lot of assets and liabilities which are not liquid at all. And the leverage on those, the structural leverage on the system, in my view, is way higher than in 2008, is way higher than during the long-term capital kind of, disaster, which I was personally involved when I was there. And I think, that would be a very different market. So, we had instances of, for example, of the GAM funds. We had instances of other UCITS funds having trouble. We had the Greek stock ETF being suspended in 2012. I mean, can the market really sustain a big ETF suspending the redemption or a big UCITS because something unexpected has happened? I mean, if the best in class of the hedge fund industry got destroyed in January, February, being short meme stocks, what is the chance that an ETF with no risk management is going to have a problem with calibrating the liquidity demand? So I think that's the biggest risk that I see. And again, it's very correlated with COVID. I mean, the moment COVID is not a problem, to me, the one thing I will become the most worried about the market is if tomorrow Pfizer announced that they got drugged to treat COVID within 24 hours. That will be, to me, the now take off your chips, start with fixed income, and then eventually the rest. Because liquidity is a misperception. Most evaluation, anything we're looking at, whether it's Microsoft, whether it's BTP, Bund, is only there because a monetary base being created. And a monetary base has got cumulative effect. Monetary base came to buy debt, which was very, very old. So I had no impact in the real pricing of security or real pricing of services and goods. But increasingly over the last 10 years, there's been a lot of the old debt that's been retired. It's like retire, old car. But now the new debt, the new monetary expansion is for new debt coming in, and that is like a competition. Yeah, it's gonna there's gonna be these monsters of government expansion that are gonna have to be fed, and if central banks are not there feeding it, then there's gonna be a problem. So I think the biggest risk that I see is in the infrastructure, the liquidity, and if there is something blowing out and created a systemic effect, which I think in general we were potentially quite close to. It didn't happen because he attached hedge funds, but if it had happened to an ETF or a big usage with daily liquidity, I think the picture would have been very, very different. And we've seen it with central banks in the past, in the previous crisis, where they're not going to be able to do what they did with long-term capital. And long-term capital was like, 5-6 banks meeting together, having a phone call in the afternoon and fixing it within, a week was done. You're not going to be able to do it this time because banks are not allowed to do it. So the banks will not be able to go, okay, I'll buy the portfolio at 30 cents below because I'm going to make a killing. This time, banks are not going to be allowed to do it full stop. So then you're just going to watch it and see it. And that would create issue. I mean, think about what happened with the meme stocks. Why GameStop didn't issue shares? Why didn't they manage to get them to issue shares? So you can have that's what I think is the biggest risk for us by far. The other, obviously, the opposite of that is obviously idiosyncratic investments that go wrong, and that's why we're trying to be very diversified. Obviously, to a certain extent, the usage regulation is quite demanding from that point of view. So you need to have a minimum diversification anyhow. And on top of that, obviously, we're trying to buy liquidity option, which currently we still think is going to be very much the fixed income to offer that liquidity to protect the portfolio.
We have a question. So, which are the main macro bets you have on as of now?
Well, I think the main macro bets right now is that we are short fixed income. I know we really believe, UK is way ahead. So I think UK definitely one short fixed income. US is definitely a short fixed income. So overall, we're short rates, typically through put option or outright. Those are probably the big bet, if you want, from a macro point of view. And again, the other side of it is that I think credit is still relatively safe. Obviously, equity could be a little bit more, under pressure. If really we go past the vaccination, I think then you can start being much more discriminating on big macro credit. So at the moment we're quite short in emerging markets. We're really negative Turkey. We're the big short on Turkey. We're keeping the short on Turkey, and like them, Brazil, South Africa. It's going to be a reversal of the last 10 years, and it's going to get faster, quicker, and sooner the more we can, get out of the COVID, world and start reopening, on which I feel very confident on. And as opposed, again, to the last 10 years, this time central bank is going to be a little bit faster in not adding stimulus, because that's exactly where we are. If there are 250 billion every month, the moment that they're not 250, there's even 150, that is like 1 trillion equity of cash coming down on a yearly basis, when the supply of that is actually probably as much, if not more, higher than that. So there's going to be a big impact.
Cool. I think we covered pretty much opportunities, and so we thank you everyone for participating today, and we stay at your disposal for any question. Thank you very much. Grazie
Thank you.
Filippo.
Thanks, guys. Thank you. Bye-bye.